Welcome. Thank you for joining us for our third quarter outlook titled Balancing Act. The title reflects our belief that right now the Federal Reserve is behind the curve, chasing inflation, trying to raise rates enough to slow the economy, to get inflation under control without tipping the economy into recession. Now, inflation, of course, has been much more persistent and higher than anybody would have imagined, including us at the beginning of the year. And this has created a very challenging environment for virtually every asset class. To that point, if you look here at returns midway through the year across all major asset classes, you can see virtually everything is at a loss. The one exception is alternatives in the form of real assets, which would be timberland and agricultural property. Other than energy, those are the only things that are actually enjoying a positive return this year. Now, it's no surprise that equities are down 20%. That sort of volatility in the equity market is sort of the price of admission for investing in equities. There is inherently a volatility related to that. What's really dramatic and stands out most this year is what bonds have done, because historically, as you know, bonds are a safe haven. Bonds provide income and safety. Typically, when stocks are under acute pressure, money flows out of the risk assets, which is stocks, goes into bonds, driving their prices up and yields down. In fact, only 2 times in history have both stocks and bonds suffered losses in the same year. Until this year, this marks the 3rd year. Not only that, but the magnitude of the loss really stands out. Prior to this year, the worst loss for bonds as measured by the aggregate bond index was 2.9%. As we stand before you today, the aggregate index year to date is down almost 12%, almost 4 times the worst year ever. Now, as you can see here on the next slide, we have a scatter diagram that on the y-axis plots the return on the S&P 500 stocks, and on the x-axis bonds. And you can see that most of the returns historically are in the northwest quadrant, meaning bonds have had a return of around 5%, stocks around 10 or 12%. Very rarely is there a loss in both. And you can see the outlier that this year has become way in the southwest quadrant here, way away from everything else. Not only both asset classes experience negative returns, but significantly negative. So this has been a very extraordinary period where both stocks and bonds are not only experiencing negative returns at the same time, but profoundly negative in the case of bonds. Now, our belief is, though, that the Fed has just begun raising rates. And remember, the Fed only controls Fed funds, overnight rates, if you will. To that end, here we have a chart that shows in blue where interest rates were for various maturities at the beginning of the year, and green indicating where the yields are now on instruments across various maturities. And the point is this: the Fed's raised rates 3 times for a total of 1.5% of Fed funds. Everything else across the curve, the 2-year maturity and the 10-year treasuries and even the 30-year mortgages, those yields are not determined by the Fed. Rather, those are determined by supply and demand forces in the marketplace. And the Fed has telegraphed an intent to raise Fed funds up to about 3.5%. Well, as you can see here in the green bars for 2-year maturities and 10-year maturities, investors have already driven up those yields to that point in anticipation of where rates are going to go. 30-year mortgages have gone from about 3% up to over 6%, so 300 basis point increase. In other words, investors have anticipated and priced into the marketplace where they think ultimately rates will settle. Now, as far as having economic traction that the Fed intends, a good example are 30-year mortgages that are up over 300 basis points from 3.3% at the beginning of the year to over 6% today. What does that mean for Main Street? What that means is a $500,000 mortgage would have cost at the beginning of the year about $2,000 a month. Now, if you were initiating a 30-year mortgage for $500,000, it would cost 50% more, about $3,000 a month. So there will be traction economically. It will take some time. But the point is the bond market, the pain that we highlighted a couple pages back, has by and large already been felt by bonds and stocks. Now, inflation. Our belief is that we're starting to see a peak in inflation. It remains to be seen how quickly it rolls over. Here we see inflation segmented 2 ways. Headline, which you see every month in the blue line, currently running about 8.5%, and then core, where you strip out the volatile series of food and energy. It peaked in March in our view. It remains to be seen if this is going to continue downward unbroken or whether there'll be some hiccups. But again, the Fed's watching this. This is what we're trying to get under control. Until it is under control, market volatility is going to continue. Now, One of the things that has been fueling inflation is the very tight labor market. To that end, this next slide shows an unprecedented environment here where we have twice as many job openings as people looking for work. That's a good news if you're looking for work. We're seeing wage pressures, but the fact is the Fed is looking at this and it provides a lot of leeway for the Fed to destroy demand for jobs, if you will, before you actually start destroying jobs and causing actual layoffs, but rather slowing demand for goods and services so that businesses feel less of a need for more employees without cutting existing employees. Again, that's sort of walking the tightrope of slowing things down without causing a recession. Now, speaking of recession, the consumer comprises 70% of the economy. So as the consumer goes, so goes the economy. Well, right now, unemployment at 3.6% is 1/10 away from the lowest it's been in 50 years. People are employed. They're clearly seeing wage increases like they haven't seen in a generation. And oh, by the way, you see on the next page here, if you look at cash, they're very wealthy right now. They're very liquid and they've been spending it. Again, inflation, the textbook is too much money chasing too few goods. And the consumer is employed, has a lot of money, and they're spending it. Again, there's been a lot of demands for goods. Now that's shifting to services inflation. The good news here is that if we have a recession, which is not our base case, it's going to be very shallow because the consumer's in great shape. Corporate balance sheets are in great shape. So in a recession, again, not our base case that it's anytime near, but if it is and we're wrong, it's going to be very short and very shallow. And speaking of recession, the stock market already is discounting 2/3 of an average recession. By that, we mean that in the average recession, the S&P sells off 30%. The market's down 20% right now. And furthermore, as you can see on the next page, the average return compounded annually for the S&P is 12%. However, if you look at instances where the market is down 20% and look at the following year, the average return is twice the average return. It's 23%. So again, at this juncture, it is too late to sell risk assets. Things are on sale. You should stay the course and be rewarded. So in summary, the Fed's behind the curve. We think that stocks and bonds, by and large, have already discounted the full tightening cycle. It remains to be seen whether inflation is peaking this month or next, but it's in the process of peaking. And the real story is how quickly will it get under control and recede in a material way. Until it does, until there's evidence of that, market volatility is going to remain elevated. We don't believe that a recession is imminent. However, if one does manifest itself, it's going to be very short and very shallow. And oh, by the way, equity markets are already by and large discounting an average recession. As such, we think we should stay the course, remain invested in risk assets and alternatives. We think things are on sale and you'll be rewarded for your patience. Thank you so much for joining us. Take care, have a great summer, and we look forward to catching up with you in the fall.